try to continue our videos about investing. So today we try to see investing for the long run. Okay, investing for the long run, it's when you invest for many years, like decade or two, 10 years, 20, 30, for all the whole life. So here, most of the time, some people, they buy, this is how do they make their portfolio. Okay? They choose some stocks. For example, they choose, let's say, 10 stocks. Okay? 5, 6, 7, 8, 9, 10. Okay? Now when they choose them, they should choose and opt for fundamentals. It means fundamentals, it means they should see earnings, the expansion of the company, and if it has new products, if it is strong, less competition, a lot of stuff in the fundamentals. Now when you choose your stocks, you leave them for 1 year. Okay? You leave them for 1 year. The stocks that you lose money, for example, you lose money in these 4 here. So you take these 4, you delete them from your portfolio, and you add to the list 4 new ones. Okay? Now, some other people in their portfolio, they buy stocks, okay, and they don't touch them. They leave them for 10, 20, 30, 40 years. It means the whole life. As Warren Buffett has done the same. He bought few stocks, few companies with a lot of money, and he stayed the whole life holding them. Okay? He bought some and he sold them. It's just for trading. Okay? Not for investing. So, investing for the long run, you should learn a lot about the company. You should learn about the company. At least the earnings. Okay? If a company doesn't make money, so why you buy the company? Okay? This is like from a fundamental point of view. And if a company has a lot of competition and the company cannot compete with others and it is losing money each year, okay? Suppose, like before, I give you just an example. Companies like Bank of America, Bank of America before, like 2 years ago, the stock was $64. And it goes to, I think, $3.50. Now I think it's $7 or maybe it's $10. Okay? If a company, if this bank is losing money in 2 years, it lost everything, 80% or 90%. So why you buy this company and you hold it, and you see that the company year after year, and you are losing more and more money. So you should stop this and replace this company with another one. Okay? Or if you like banks, choose another bank that when you see the stock, for example, Bank of America, it was like this, it's going like this, and now it's like this. Okay? This is Bank of America. Now, why not choose a bank like this? If you choose a bank like this, 10 years or 15 years, it's better than to use a bank like this going. Because, why? I give you just something very important. When you see in a company for many years going down, for example, it was $110, and each year, it's like this. 110, 90, 70, 60, 50, 30, 20, and if you still hold this company and you know that year by year it is losing money, you are losing all your money. Okay? That's why when you have a portfolio, you have less risk. You have less risk. Okay? Why less risk? Because when you buy a lot, it's impossible that all these will sink. It's impossible. Okay? If all these sink, it means you have a very bad luck and you should stop going to the stock market and you invest in another thing, because maybe there is a curse on you. Okay? This is what I'm thinking. So, and what they do is that they don't buy from the same sector. For example, you choose here a bank, now next stock, insurance, internet stock, mining stock. It means each time you change the sector, don't buy all your things with the same sector. Don't buy all the banks and you stay there. No, buy banks, insurance, mining, buy commodities like gold and stuff. Okay? Buy this stuff. Now, when you buy all this stuff, someday will go up, someday go down. This is the market. So you have less risk. But suppose you buy one stock, one. And suppose the stock is going down. Okay? So you are losing all your money and you are doing something which is risky. And you told me, for example, oh, okay, I bought a stock, but it's always going up in many years. You are lucky. Okay? You are lucky that you have one stock and you will have an excellent reward. An excellent reward because the risk is too much. When you have the risk is too much, the reward is too much. Okay? The risk is following it. There is no a safe investment and you have a biggest reward. There is no. That's why if you think about mutual funds or ETFs, these are like a portfolio. Okay? ETFs and mutual fund, they are just a connection or collection of stocks or bonds or something, and because they are a lot, so the risk is minimized. And you see that, for example, mutual fund, you find it like this, but in majority you see that the stock is going up. ETFs, mutual funds, almost of the time they are going up. Why? Because we have a lot of diversification. Okay? But they don't go too much. It depends on the mutual funds and how do they do. Okay? So investing for the long run, you should buy stocks and leave them. Some of the other people, they buy and leave. They buy others and leave. They buy others and leave. They just buy and leave. And in the future, most of the time, the stock market is going up and up and up, and they will make too much money. Okay? If you see, for example, $40, you can have $1 million like in 40 years. Now, this is the past, okay? I'm not saying that you have $40, in 40 years you have 1 million. We don't. But this is what the past has done in the stock market, okay? So for you, you invest, you put your money, choose the companies that you like, and you just wait, okay? This is the investing for the long run. So here you are not trading, you are not buying and selling. And there is another thing which is good. When you buy and hold, it's for tax. You are not taxed, no tax, until you sell, except for dividend. Dividend you should pay something, but generally there is no tax until you sell. So your money is growing and growing and growing without selling anything. Okay, thank you very much for this video. If you have any question, please subscribe and ask questions if you have. Thank you very much.